All right, let's jump right in. That classic 60-40 portfolio, 60% stocks, 40% bonds, it might just be a 100% liability right now. Why? Because when you get stagnant growth and soaring inflation at the same time, the old rules of diversification just completely fall apart. Today, we're not just talking about inflation. No, we are diving deep into the institutional playbook for stagflation, a really treacherous environment where, frankly, most investors get caught completely flat-footed. Look, when the market gets this chaotic, it's so easy to feel lost. But here's the thing you have to remember. The smart money doesn't panic. They have a script, a literal playbook for these exact moments. So the real question becomes, when both stocks and bonds are falling together, where is that money actually going? What are the deliberate, calculated moves they're making behind the scenes? Well, that's exactly what we're here to uncover. So here's our game plan. First, we're going to define stagflation and explain why it's such a portfolio killer. Then, we'll get into the main event, the institutional playbook, and see how they shift their capital. After that, we'll zoom in on the key defensive sectors, check out some really interesting counter strategies, and then wrap it all up by helping you figure out what's your strategy. Okay, let's get into the heart of the problem. Stagflation. It is a particularly nasty scenario because it breaks the fundamental rules we've all learned about building a portfolio. For an investor who isn't prepared, it's like a silent, grinding account killer. So to navigate it, you first have to really, truly respect the threat. So what exactly is stagflation? Well, the name kind of says it all. It's this toxic mix of economic stagnation plus high inflation. The economy isn't growing, unemployment might be ticking up, but the cost of everything you buy is still going through the roof. It's basically a central banker's worst nightmare. You know why? Because the cure for one problem, like, say, raising interest rates to fight inflation, makes the other problem, stagnation, even worse. And here's the critical part. This is when that beautiful negative correlation between stocks and bonds just vanishes. They can, and they often do, fall at the same time. So why is everyone talking about this now? Well, because today's economic picture looks eerily similar to the 1970s, which was the last major bout of stagflation we had. You've got a major oil shock, you've got high inflation, and it's all happening after years and years of easy money. The parallels are honestly striking. And here's the piece of data that really matters. Economists have this rule of thumb that every sustained $10 increase in the price of oil shaves about 0.2% off of GDP growth. So think about it. If oil jumps $30 and stays there, that's a huge drag on an economy that's already struggling to grow. And that brings us to the core of this whole thing, the institutional playbook. When these big institutions see the warning signs flashing and they see those old correlations breaking down, they don't just sit there and hope for the best. No, they execute. Their strategy is called sector rotation, and it's a very disciplined shift of capital out of high-risk areas and into zones of relative safety and quality. Now, this isn't guesswork. It's a very methodical top-down analysis. They start with the biggest picture possible. Is the overall market in an uptrend or a downtrend? Simple question. Then they filter down to the sectors, figuring out which ones are leading and which are lagging. From there, they dig into specific industries, and only at the very end of this whole process do they start picking individual companies that have very specific desirable traits. It's all about finding the strongest players in an otherwise weak environment. This is probably the best way to think about it. Imagine a football game. In a bull market, you've got your star offensive players on the field, your high-growth tech stocks that can score big points fast. But when stagflation hits, it's like a torrential downpour during the game. The field is a mess. What does the coach do? He benches his flashy scorers and sends in the defensive line. Those big, sturdy, reliable companies that can just hold their ground no matter how bad the conditions get. So let's follow the money. Where does it actually go? Capital flows out of speculative tech, consumer discretionary, that's the wants, not the needs, and cyclicals that really depend on a strong economy. And it flows into these defensive sectors. Consumer staples, utilities, and healthcare become safe havens. But in an oil-induced stagflation, energy becomes this crucial fourth pillar. It's not just defensive, it's a direct hedge against the very inflation that's causing the problem in the first place. All right, let's put these defensive sectors under the microscope. What is it that makes these specific areas the designated safe havens? Well, it really comes down to a few key characteristics, specifically what professional investors call the quality factor. First up, consumer staples. We're talking about companies that have high pricing power and really stable demand. They sell things people need, not just things they want, food, drinks, household products. This allows them to pass on rising costs to us, the consumers, which protects their profit margins. And that is a hallmark of what they call a quality company. This quote just illustrates the point perfectly. In tough times, you might skip that expensive restaurant dinner, for sure, but you're probably still going to buy a Coke at the grocery store. This is the whole essence of consumer staples. The demand doesn't just disappear, it shifts. And this inelastic demand creates the predictable, stable cash flows that institutions absolutely crave in a volatile market. Next up, we've got utilities. Now, like staples, they provide an essential service. I mean, you got to keep the lights on. But they also benefit from being regulated monopolies in a lot of cases, which leads to highly predictable revenues and often very stable dividends. And in a world where capital gains are hard to come by, a reliable dividend check becomes incredibly attractive. And the third major defensive player on the field is healthcare. This one operates on one of the most fundamental principles of human need you can possibly imagine. This quote really captures the brutal truth of it, right? Sickness does not check the GDP report. This fundamental, non-cyclical demand makes the healthcare sector exceptionally resilient. Companies with strong drug pipelines or essential medical devices, they exhibit that quality factor we talked about, low debt and an ability to maintain pricing power. That's exactly what institutions are looking for in a downturn. But wait, the institutional rotation into defensive stocks, it's not the only playbook out there. And this is where it gets really interesting. There are other powerful and very different philosophies for navigating a downturn. So let's explore 3 really distinct counteroffensives. First up is the bottom-up purist. Their strategy is pretty simple. Just put on blinders. Ignore the Fed, ignore inflation, ignore the entire macro picture. The only thing that matters is finding a truly exceptional company, a potential 100-bagger. The core belief here is that a world-class business, one with a really durable competitive advantage, will thrive no matter what the economic weather is like. Okay, the second counter strategy is the hard asset advocate. This playbook avoids paper assets, stocks and bonds, almost entirely. The philosophy is to use good debt, that's fixed-rate borrowed money, to buy tangible, cash-flowing assets like real estate. The model is so powerful. Your tenant's rent pays your mortgage. And in an inflationary world, you're paying that loan back with cheaper and cheaper dollars, all while your asset and the rent it generates are going up in value. It's a game of control and cash flow. And our third playbook is the productivity investor. This is a fascinating, really forward-looking strategy. It argues that in an inflationary world, just owning the market index isn't going to cut it. If the whole economy isn't becoming more efficient, your returns are just going to get eaten alive by inflation. So the only real way to get ahead is to invest in the source of that efficiency, technology that drives productivity. Think AI, automation, these are deflationary forces, and the companies creating them are the true engines of long-term, inflation-beating growth. So, okay. We have the institutional playbook, and we have 3 very distinct counter strategies. This brings us to the final and most important question of all. How do you synthesize all of this into a strategy that actually works for you? This table does a brilliant job of summarizing the 4 philosophies. You've got the institutional approach, which is driven entirely by the macro signal. Then you have the bottom-up and hard asset players who basically treat the macro environment as irrelevant noise. And finally, you've got the productivity investor, who sees the macro problem of inflation as something to be actively solved by specific tech investments. Seeing them side by side like this makes the strategic trade-offs crystal clear. And this is the most important point of the whole thing. The goal isn't to find the one right playbook. The real power is in understanding that these strategic capital shifts are happening right now as we speak. It's about recognizing the brutal truth. During stagflation, a lot of retail investors buy the dip in their favorite tech stocks, not realizing that rising costs and flat consumer spending are absolutely crushing their profit margins. The key is to avoid that trap by having a conscious, deliberate strategy that you truly understand. So we'll leave you with this thought. The institutional money is already on the move. This isn't a theory, it's happening right now. The playbooks are running, and the signals are out there for everyone to see. Now that you know what to look for, that rotation into quality, the search for productivity, the flight to hard assets, the only question left is, which signals will you choose to follow?